Hi everyone, and welcome to Price Action Trading School version 2, session number 20. And today we have a divergence, charting divergence, our session that is dedicated to divergence. So let's see what we can actually, how we can use divergence in our trading. Before we start, have in mind that everything you see and hear from me is my personal opinion only. And have in mind that Forex is a risky asset and a risky market. So you should definitely pay attention to the risk. The risk management is the holy grail in Forex trading. Today's agenda is Divergence Explained and different types of divergence. And during next sessions, we will also see how to trade with divergence. So I will be, as always, very quick, very concise, and straight with information. Divergence, in its purest sense and basic definition, is when the price and the indicator are in disagreement. So the indicator goes one way, price goes one way, the indicator goes another way. Basically, that's it. So when the price is not following the indicator and vice versa, we have divergence. So price is diverging from the indicator, or the indicator is diverging from the price. That is a bit simple. So they move in the opposite direction. Usually we have the price and the oscillator. So we don't use I personally don't use some fancy indicators for showing me divergence because I can chart it myself. But if you're a beginner, there are also some automated divergence indicators. Some are okay, some are not okay, that might help you out in finding the divergence. But as you gain experience in Forex trading and generally in Forex markets, you will start to see those divergences automatically. Just by looking at a chart, you will be able to spot a divergence. So usually we use price and oscillator. The price is, of course, the main thing in divergence, and the oscillator can actually change. I use MACD, some people use CCI, Commodity Channel Index, awesome oscillators, and of course the Relative Strength Index, RSI. I personally like to stick with the MACD. Divergence is basically used mostly for counter trend trades, but not all divergence is used for counter trend. Some divergence are used also, such as hidden divergence. It's used for trend continuation. Also, when divergence is coupled with ATR high and low, the chance to have a winning trade raises by approximately 10% per my overview of divergence and the ATR. So for me, counter trend trades are always best used with the ATR and with the divergence. Of course, divergence will also show during end of day trading when there is some profit taking. EOD means end of day. So usually when we see some profit taking, we also can see the divergence happening, and the price might actually start to go up or down depending on divergence. Divergence requires confirmation, so you cannot trade it blindly. It doesn't mean if you see divergence that will be actually executed. So divergence always need to be traded with the confirmation. You also need to pay attention to manual detection. As I said, try to practice divergence charting as much as you can, because as I say, there are a lot of indicators that will show divergence, but not all of them are actually good in detection. Some are false, some are showing some non-existent divergence, some are showing too many divergences. So just try to spot it manually. We use regular divergence for counter trend, and we use a hidden divergence for a trend continuation. Now, I will show you different types of divergence. Okay, first we have a regular bullish divergence. Regular divergence is usually the most frequent, and we consider it a sign of trend reversal. So regular divergence is when trend is or retracement is happening, so the trend might change. If price is making lower lows, but the oscillator is making higher lows, this is considered to be regular bullish divergence. This is important, guys. We don't need a series of lower lows. We just need one low to be lower than the previous low. So you don't need a series like 1, 2, 3, 4 histograms. You just need one. okay, and it can be found near the bottoms. This is how it looks like. This is a regular divergence, and this is, guys, how it looked like. So whenever you see that the price is making a lower low, okay, and the indicator is making a higher low, this is bullish divergence. Now we go to regular bearish divergence. Again, bearish divergence is also a type of divergence that is used usually for counter trend moves. If the price is making a high high, but the oscillator is making a lower high, then we have a regular bearish divergence. And usually it can be found near the tops. This is how it looks like. Market is making a high high, while the indicator is making a lower high. So it looks like some sort of megaphone pattern. Hidden bearish divergence. Now, hidden divergence is not frequently used as regular divergence. And now we have hidden divergence that is actually the opposite of regular divergence. And hidden bearish divergence is when price is making a lower high, but the oscillator is making a higher high. Okay, and this can be seen when the pair is in downtrend. Hidden bearish divergence hints to the chart continuing to go down. Okay, so hidden divergence is actually a type of divergence that can be seen when price is following the trend. This is how it looks like. Okay, you have some sort of running triangle at the tops, both on the price and on the indicator. Hidden bullish divergence is when price is making a higher low, but the oscillator is showing a lower low. And usually we see hidden bullish divergence when price is in uptrend. What it means is that a hidden bullish divergence hints to the chart continuing to go up. So a higher low on the price, a lower low on the indicator, and the price usually continues going up. And finally, reverse divergence, or some call it exaggerated divergence, is a special type of divergence that can be found either at the top of the move or at the bottom of the move. Usually those moves are larger. And what is also important, guys, that reverse divergence is similar to a regular divergence, but it's slightly different. This is how it looks like. So for reverse bearish divergence, we have double top at the price, but the indicator is showing a much lower high. For reverse bullish divergence, we have double bottom, or the price could be double bottom-ish, while the indicator has a much higher low. Have in mind that here in these reverse divergences, price either if it makes double top, like in this example, it does not need to be a perfect double top. Basically, the price should look double top-ish. You know, it should look like a double top. But also here, the price can also look like double bottom. So it's as it says here, second price low should appear like double bottom-ish. So like it's making a double bottom. And in indicator here is important for reverse bearish divergence. The indicator makes a much lower high, and here it makes a much higher low. So let's see, guys, how it looks in the practice. For example, we will chart divergence right now. We will start with, well, regular bullish divergence. So again, regular bullish divergence, market or the price. When it says market, it's actually the market you trade. This is the price. So a lower low on the price, a higher low on the indicator, okay? Lower low on the price, higher low on the indicator, okay? We can find whatever, guys, market you want. Higher high on the price, lower low. We need to insert MACD indicator. So I will instantly use my MACD. And this is how you can also use my MACD. It's very, very good for spotting divergence. MACD. And we will just change the color. Or we will have, of course, red and blue. And this is it. Okay, so we can spot divergence easily. When you want to spot divergence, it's good that your MACD is a little bit, you see, higher on the chart. Not by default, because on default it will look like this. Just put it a little bit higher. So we need to have, guys, a lower low and a higher low. So I'm just watching this, and yeah, I immediately spotted the divergence, guys. So you always need to place it from the right place at the indicator, and also not just from the indicator, but also from the mark, from the price point of view. So we are trying to spot a regular bearish divergence, right? Let me just check the slide once more. No, bullish, sorry, regular bullish. Okay, so regular bullish divergence. Okay, I'm scanning, guys. I really don't need an indicator for this. Almost here. You can easily spot it also when you have experience. So we will try to spot it. We need to have basically a lower high here and a higher low. So I didn't cherry pick anything. So I'm practically doing by my naked eye. I see a different divergence here, but not the one that we need. But yeah, here it is. Some sort of divergence here, bullish, definitely here, guys. Exactly from the same spot, you need to pull the trend line. So from this spot, guys, exactly from that spot, guys, okay, you see? Yeah, it could be also reverse divergence, definitely. Reverse bullish, but you get a point, see? It looks, this is mostly like the reverse divergence, but very good example, because we won't find a lot of examples on reverse divergence. So here it is. Basically, what happened? The price started to go up after this divergence. Now, guys, we don't talk about how to trade it, but we mostly chart it now. I just want you to learn how to chart, and then you can actually use it for trading. Yeah, now we can do it on different time frames, of course, guys. Yeah, here it is. Great. This is divergence. Here. And you see here, exactly from the same spot, guys, you need to do it. I mean, this is a lot of people and traders get it wrong. They are starting to draw anywhere. You need to draw from the same spot, both trend lines, guys, exactly from the same spot. That is important. Okay, so this is regular bullish divergence, okay? Now, let's see if we have the example for, yeah, let me see. It's regular bearish next. This is regular bearish. We have some sort of megaphone at the top. A higher high on the price and a lower high on the indicator. So a higher high on the price and a lower high on the indicator. Okay. Higher high on the price, lower high on the indicator. Okay, I'm trying to spot it. We have, you see, higher high, but we also need to have a lower high here. So bearish divergence, very good for counter trend trades. Yeah, no, this is not okay. We have a higher high here. Yeah, this is it. Here we go. So we need to mark it completely. Here it is. Regular bearish divergence. And what happened basically after the price? You see what happened? The price was struggling to go down, and then finally it dropped from this spot. Bang. It struggled, but then bang, it dropped from this spot perfectly. So nice regular bearish divergence, guys. See? Okay, next one. Next one is hidden bearish divergence. This is continuation. So we don't look for retracements or reversals. We look for continuations. Hidden bearish. We have a lower high at the top and a higher high at the top of the indicator. So a lower high and a higher high. So a lower high and a higher high, hidden divergence. Lower high and a higher high, almost here. Lower high, higher high, I don't see it. No. Well, higher high, but we don't have a lower high. Okay, we are scanning. Almost, yeah, almost. You will see when you get into this, it will really be, I mean, now I'm looking through the whole chart to find examples, but you can look once, twice per day, depending on the time frame, and see. Usually it's the best to trade it on 1 hour and higher time frames, not on lower time frames. On lower time frames, it's not good. Definitely, it's not good. I don't recommend it. Okay, lower high, higher high. I think I spotted it here. Yeah, very close, but it's definitely here. Yeah, you see, from this spot, basically from this spot, actually, it made a high here, like this, and we have it like here. Yeah. So what happened? Price went up. This was uptrend, then the retracement, hidden bullish divergence. Okay, and what happened? Basically, the price went up. Yeah, now I remove this, but this is it basically. So you see, price went up, then it started to drop, still uptrend. This is low, this is high, and bang. So hidden divergence is continuation type of divergence, not reversal. Remember that. Yeah, basically, we actually, I spotted the wrong divergence. Yeah, this was actually hidden bearish, but let me check something. This was not good example, guys. Wait. Yeah, the price dropped here, but this is not a good example because it went up. Actually, this is a good example, but we didn't have a trend line break that would qualify for a trade. You see, there was no trend line break. And yeah, this is bearish divergence, not bullish. Let me find other markets. Usually these other pairs here better. So yeah, we will find another one, bearish, and it needs to go down. I want to show you a successful example of a hidden bearish divergence. So we need to look for a downtrend. And yeah, I think here it is. Yeah, continuation. Here, we will mark it like this. Okay, from this spot to exactly this spot here. Yeah, and this is it. You see how the price actually, yeah, we can use it like here also. It's much better example here. And what happened? Bang. And the price went down. So yeah, hidden bearish divergence. A very good example. Yeah, we place a trend line, one way to trade it, and then it goes down. So this is hidden bearish divergence. Okay, a good example of successful trade. And now we go to hidden bullish divergence. It needs to go from the bottom. So remember, hidden bearish goes from the top, hidden bullish goes from the bottom. Higher low and a lower low. Okay, so higher low and a lower low. Let me check, let's say GBP dollar. Okay, higher low, lower low, higher low and lower low, guys. Okay, and the trend should be to the upside. Yeah, here. Here and somewhere here. It started actually from this spot. Okay, we need to go a little bit lower here, exactly at this spot. As I say, always follow the price, always, guys. Okay, so this is it. Here it is. And what happened? The price still made an up move after the divergence showed up. We had a trend line break and 158 pips to the upside. This is 4-hour time frame. So usually on 4-hour time frame, you see a bigger movement. But This was the last chance that the price will go up. After this divergence, then it started to drop. And as I showed on the example, the first example, the reverse divergence is a bit harder to find, but you need to spot always double top, okay, for reverse bearish divergence, and double bottom for reverse bullish divergence. You need to practice this, guys, because when you start to practice charting, then only then you will be able to spot it manually, and you don't need an indicator for this. So far, most of the indicators have not been correct, and that is why I like to see it manually. I don't need thousands of divergences. I just check if I watch it on 1 hour time frame. I check it once in 1 hour, so each hour. If I go to 4 hour time frame, I spot it once in 4 hours. For daily, I just spot it once per day. But it's important that trading divergence cannot be done instantly. When you see a divergence trade, you need always to be to wait for different parts of the confluence in order to trade divergence. We will talk about it in some of our next lessons. So far, guys, this was just about how to chart divergence. Practice this. When you are familiar with this, only then you will be able to get to next class when I talk about how to trade divergence. Thank you for listening. If you have any questions, go ahead and ask. This webinar is being recorded, and it will be uploaded to our ECS YouTube channel. So whatever is not clear, guys, just feel free to ask. Thank you for listening. I don't see any questions. So yeah, next session is next Wednesday. Until then, guys, for Price Action Training School, cheers and trade safe.